Hey guys, let me try this again. I had to stop the other one. So, last chapter we talked about how the companies are going to finance these assets that they're going to need to purchase. So, in this chapter, it talks about buying those assets and paying that property tax. And then we talk about depreciation and some other stuff. So, the first part here is just buying those assets that we're going to use. And so, anytime we buy an asset, we want to make sure that it's going to last as long as it's going to allow us to get a return on our investment. So I'm not going to spend $100,000 on something I'm going to use once. I've got to be able to, unless it makes me $100,000 the one time I use it, right? I've got to be able to get some kind of return on my investment. So we want to make sure that everything that we buy, we're going to have for the appropriate amount of time that it's going to be worth it. Okay. So whenever I buy an asset, and because I'm paying, right, I'm going to be using my cash payments journal. So in this case, on January 3rd, I paid cash for a shelving unit, 8,500, check number 612. So here's my, you'll see the T accounts. So this is a shelving unit I'm going to use with my customers. So it's going to go under store equipment, and then cash comes, and then it's going to come out of cash. So you'll see in my cash payments journal, my date, my account, store equipment's an asset. So it's normally a debit balance. Cash is going to be my credit. When I have to buy a group of assets, so when I buy a bunch of stuff at once, I have to do a little bit of calculation. So there's a formula on here that you're going to probably need to write down just so that you have it. So so on this example, I've bought two different assets, one that's valued at $7,500 and one that's valued at $2,250. So their estimated value together is $30,000. Now here's the kicker. I'm not going to pay $30,000 for those. They might be valued at that, but I'm going to get a deal, right? Because I'm buying both. So this is why we have to figure out how much actual cost we're going to assign them. So this is how you do it. So you take one of the assets, doesn't matter, but in this case they used asset number 1, the 7,500. They divided it by the 30,000, and it came up with 25%. So 25% of that 30,000 is the value of the asset, the first asset. So now we're going to take what we actually paid for it, both of those assets, and we're going to use those percentages to figure out how much cost we're going to assign them. So my total purchase price was $27,000 for both. So even though they were worth 30, I only paid 27. So I'm going to take 27,000, multiply it by the 25%. So that first asset that I bought that was worth 7,500 only cost me 67.50. Okay? This is the formula that you guys are going to have to write down. So I'll give you a second. We're going to do the same thing for asset number 2. So we're going to take our asset number 2 was valued at $22,500 out of the 30. Obviously, 25 minus 100 is 75. Our purchase price was $27,000. Divide that by your 75 or multiply it by 75, either which way. And the asset, and this says cost assigned to asset 1, it should say asset 2, is $20,250. So even though it was worth $22,500, I'm only going to assign it $20,250. Now here's how I'm going to record that. So I have one was a copy machine and one was a display case. So the copy machine obviously is office equipment. So there's my $67.50, even though it was valued at $75. This is 25%. My store equipment was the display case. So it was valued at 75% of the 27, which is the $20,250. My cash is going to be recorded as my 27,000. So this is how it's going to be recorded in my journal, okay, in my cash payments journal. Any type of property, land, anything attached to the land, like a building or any like a building, is called real property. That I'm going to have to pay property tax on. So our personal property, that's our personal property, like your own house or whatever. You're going to have to pay property tax on that too. So in Elmore County, the assessor comes around, they assess everybody's property value, they have a calculation for it, and then they send you your assessed value and say, this is what you're going to be paying your property tax on. So this is how that works. So now most of the time they're going to just tell us what it is. We're obviously not going to be calculating a lot of property tax, but they're going to show you how it's going to calculate. So in this case, the assessed value of the property was 80,000. They came up with a tax rate of 1.3%. That is actually about normal for property taxes. So your annual property tax would be about $1,040. So in order to pay that, obviously property tax is going to be an expense. Sorry, my back is itching. The good thing about our property tax being an expense, it's a tax deduction, so we can use it to lower the amount of taxes we pay. So that $1,040 is going to go up because it's an expense, and our cash is going to go down by the $1,040. It's a relatively easy transaction to do. The second part is calculating our depreciation. So we've talked about depreciation before. There's a couple of different ways. There's straight line depreciation, which is you're paying the same amount over a certain number of years. There's double declining. We've done that before. So where, the first year you pay like a large amount of money, the second year a little bit less, a little bit less, a little bit less until you've depreciated however much you need to depreciate. And then there's makers. So then they actually set it up by percentage in years, okay? So calculating the straight line depreciation is the easiest one. So you take the original cost of whatever your asset is. You have what's called an estimated salvage value. So after you've used it for a number of years, is it going to have any value to it? So a computer, let's say, if we are buying an asset, that computer is only going to last me 2 years. It's going to have parts value maybe, but it might not have any value at all. Okay? Let's say I value it at $50 for parts. And then that will be what's left is what I'm going to depreciate. So in this example, the original cost of the item is 8,500. They think at the end of the period it's only going to be worth 500, so I'm going to depreciate the $8,000. So I take my 8,000, divide it by the number of years I think I'm going to use it, and then that gives me my annual depreciation. So for the whole year, okay? So the next slide is now we've got to figure out, well, what happens if I buy the asset on June 1st? Well, I can't use a whole year depreciation because I'm only going to have it for June, especially if it's June 1st. I'm going to do the whole month of June, July, August, September, October, November, December. So I'm only going to have it for 7 months. So you take the annual depreciation that you calculate, divide it by the number of months in a year, which is 12, and then that gives us our monthly depreciation expense. So this one, I wish they would have continued the example, but this one they start off with 900 divided by 12, which leaves us $75 a month. Well, in this example, they take the $75, multiply it by the 4 months we used, and so that first year, we're going to depreciate it only 300. Now, the next year, we'll do the whole annual. We'll do the 9. But for the first year, we're only going to do the 3. Okay. And then that means the last year, since we only did 4 months, right? 4 months, There's 8 months. The last year will be the 8 months. Okay? So on this one, so we always keep track of how much we depreciate because we're going to depreciate only to a certain point. So our first year's depreciation plus our second year depreciation is going to equal what we have, the total that we have depreciated. So that's why it says accumulated. So my accumulated from the year before plus my current is going to be my new total. So the book value is how much value it has after each year we depreciate. So if year number one, so like this one, they've depreciated almost all of it, right? My original cost was 27. My accumulated depreciation was, or my original cost was 3,000. My depreciation was 2,700. So right now it's only worth $300, even though the original was 3,000. So how to record that and how to create that plant asset record. So the plant asset record is just a form that we create for every asset that we will be keeping track of how much the depreciation is and its value for every year. So it's really simple to fill out. So this is what it looks like. At the top it has we've assigned each asset a number. We tell it what type of account it is. So we have store equipment, we have general ledger number 1120. So that's the account, that's the general ledger that goes with store equipment. We give it a description, the day we bought it. If there was a serial number, we would write it down. We put the original cost, how many years it's going to last us, how much we think it's going to be salvageable at the end, and then what type of depreciation method. So in this case, this one was straight line. So we calculated that $2,000 for each year. So we bought it on January 2nd. So that means we get a full year as our example. So the first year, so it's 20 times, 21. We have 2,000. Our accumulated for the year is just that 2,000. And so we're going to subtract that book value, that 2,000 from the original cost, which makes it 6,500. The second year, we're going to do another 2,000. So my accumulated is 4,000 because now we have 2,000 plus 2,000. So my ending book value now is the 6,500 minus the current year's depreciation, which is 2,000. So it makes it 45. We have another 2,000 because remember, we're doing 4 years. So so then our third year, we've depreciated again 2,000. So we have a total of 6,000 so far. Drops it down to 2,500. And then our last year, year number 4, we depreciated one last time for 2,000. That gives us our total of $8,000 we depreciated. So our book value is only 500, which equals our salvage value. That's how they get those numbers. Okay, so that's how we're going to create that plant asset record. You don't write anything in that middle section, that number 2 section, until you sell it. So you're either going to discard it, which means you're going to throw it away, you're going to sell it, or you're going to trade it. So, and then they have the date that it was disposed of and then how much money. So if it was 0, you'd get it, you'd put down if you sold it, or if you traded it, you'd figure out how much your disposal amount is. So to journalize the depreciation, most of the time they give it to us. So we're going to put it into depreciation expense for that equipment. And then it goes into accumulated depreciation. So remember, those are adjusting entries. We do that at the end of the year. We don't do them every month. That adjusting entry is at the end of the year. Okay. So here's what that adjusting entry looks like. Do you guys remember adjusting entries? I know you hated them, but this is kind of what we're doing. So there's that adjusting entry. Depreciation expense office equipment, accumulated depreciation office equipment, and that's a number that they typically will give us, okay, in the book, which is, I love it. So I think the last part is then disposing of that plant asset. So we've had it for all those years. Now we need to get rid of it. So here's they're going to sell. They're going to sell that plant, that store equipment that we bought for 8,500. So you see it in our T account. I'm getting rid of the 8,500. That's why the store equipment has the arrow that's going down. Our accumulated depreciation is an $8,000 debit. So I'm getting rid of that depreciation because remember, I'm getting rid of the whole asset itself. And I sold it for $500. So I sold it for its value, right? I don't have to worry about a loss right now or a gain. We're going to talk about that. But I just sold it for its value. So it's kind of like a wash. So when I record it, here's my transaction. So my accumulated depreciation goes away because normally it's a credit. So I'm going to debit it. It's going to make it go away. I'm going to take it out of store equipment. Normally it's a debit and I'm crediting it. And then I have my cash. And then I go back into the record, which is on the bottom, and I tell it I sold it. I give it the date I sold it and then how much I sold it for. Okay? In my plant record. Now let's say I recorded a partial year depreciation on a desk to be sold. So I have a desk that I've been depreciating. I've sold it partway through the year. So we're going to figure out. So this says I added additional depreciation of $100. I'm going to reduce that amount. I'm going to add that depreciation to my store equipment. So here you'll see on the bottom where they calculated it. I normally did depreciation for a whole year was 300. So my ending book value was 800. That last year it was only for a partial year, so I calculated it. I did the per month. It was only $100, so I have to add it to my accumulated depreciation. So that's what this transaction is, adding that $100 to that equipment. So giving me an ending book value of 700. So this updates the information for my partial year. Then I can record the sale of it. Okay, then I'm going to record the sale of it. Here's the sale. Da, da, da. Okay, let's get it here. So I have the asset was worth, the store equipment was worth 2,000. I depreciated it to 1,300. Remember in that previous right here, depreciation the 1,300. Remember it was worth 700 left, right? But I sold it for 850. So there's my 2,000 minus 1,300, that's 700, but I sold it for 850. So I have a gain on my plant asset of $150. So that's where the gain is. That's where the gain comes from. So if it's only valued at a certain number and we sell it for more, we're going to gain money. So that's where that account comes in. And then on the bottom, we're going to go back into that section and go back number 2, sell, we sold it, the date, and then how much we sold it for. If we have a loss on the plant asset, this is how we're going to record it, okay? So we received cash from the sale of a computer, $200. So we sold it for 200. The original was 38. Total accumulation was 33. So if you go 38 minus 33 should have been worth 500, right? We only sold it for 2. So here's my office equipment, 38. Here's my depreciation, 33. I only got $200 for it. That's what my cash debit is. And here's my loss on plant asset, the 300. Right? Should have been worth 5. I only sold it for 2, so I lost $300. So in the so in my plant asset record, I'm going to put what day I sold it, and how much I sold it for. The double declining method is craziness. So we're going to be using a percentage as we do the double declining method. So basically, it allows us to depreciate a large amount of money in a short amount of time. So here's how you figure that out. So we want to depreciate the whole thing, the whole item. We're typically not going to have a salvage value. So we're going to depreciate the whole item, the 100%. We're going to divide it, this case, by the number of useful life. They gave you an easy example here. They gave you 5 years. So we know that straight line is 20%. Okay? 100 divided by 5 is 20. So then we take that 20 and we multiply it by 2. So whatever your percentage is that you calculate to do double declining, we multiply it by 2. So if this was 5 divided by 4 equals 25, we would put 25 times 2. So our first year rate of depreciation would be 50%. So our method would be 50. This case, they gave us 20 times 2 is 40. So this is how this works. We take our beginning value. Oh, they do have an estimated salvage value, 25, but we take our beginning value, multiply it by 40%. That's $12,000. That gives us, so we take 30 minus 12, it's 18,000. Then we start with the 18,000 on the second line, multiply it again by 40%. That's 7,200. Take the 18,000 minus 7,200 gives us 10,800. And we would continue that for those 5 years. We would keep using the 40% until we couldn't use it anymore. That last year, obviously, it won't be 40%. So we could do that 40% up until the last year. But if we did 3888 times 40%, it would take us less than our 2,500 salvage value. So we don't, that's why you see the dash there. We're just going to reduce that last year by the rate that, by the amount of by the amount of the difference between our book value and our salvage value, which was $1,388. Okay, so that's how you figure out the double declining. So you have to do your calculation first, figure out how much the declining rate's going to be. Sometimes it will be an easy amount. Sometimes it'll be a percentage. It'll be a weird percentage. Okay. Just be prepared for that. So if it was like 7 years, 100 divided by 7 would be, I don't know, let me check my calculator. So 100 divided by 7, that would give me a percentage of 14.2857, blah, blah, blah. Multiply that by 2, that would give me a rate of like 28.57. And that's the rate I would use for my declining. So it's nice when it's like 5 and 4, something that's easy like that, where you have just a regular base percentage. You don't have to worry about the decimals. Okay. That's how we would calculate the double decline. So it talks about, so it says GAAP allows each business to choose what type of depreciation method that they want to use. They can use straight line, they can use double declining, they can use makers. But if they choose it, whatever method they choose, a business has to use that same method from year to year. If they do not, they have to notate it in their information that they provide to their shareholders and say, hey, we have decided to change our depreciation method. And then they have to go through and they have to reevaluate and revalue all of their assets. So they typically don't like to have to redo and change their valuation methods. They typically want to just pick one and stick with that for the remainder. So that's something, like I said, if they do decide to change it, they have to report that to the SEC and it has to go into their stockholders report. at the end of the year that they turn in that says, this is what we've done. This is our reevaluations, da 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 da. And it has to outline it all. So obviously, we send our money to the Internal Revenue Service when we pay our, not necessarily our property tax, right, but our federal taxes. We have that system called Makers that I was talking to you about that has a that we could also use for our depreciation. And so this is what you will learn. The Makers method is what you'll learn in college. Okay, just letting you know. They'll work more with it in college. So here's just a comparison of the two. We starting with the same book value. We're ending with the same ending book value. But this is just how it looks when we depreciate. So you have the straight line on the left, the double declining on the right, and it just depends. Like this is an automobile. The double declining for the automobile might be more accurate just because typically that first year it has a higher depreciation value. But either way would be appropriate. Okay? Just so you know. If I buy something intangible like a copyright, okay? If I buy a copyright of a invention or something like that, or I buy a trademark, those are what we call intangible assets. So I can't really touch them. I can't really touch them. It's just I own the right to that. And so we do have something called amortization. Super simple. So patents, copyrights, trademarks, all of those things I can't really touch, but they are assets because they do have value. If I create a drug that's going to cure the coronavirus, that or the creates the vaccine to the coronavirus, it has value. So that I'm going to patent that, and that patent, how I created that vaccine, belongs to me. It's not an open share where everybody gets to know what piece is what. That patent belongs to me, and typically for drugs, it's about a 50-year patent. So for 50 years, only I will know how to create that drug. So this is just an example of buying that patent. It's just like buying another asset. In this case, though, we used a line of credit from the bank. So it's still, we're still using our cash. I don't know why it says line of credit. It should say cash. I didn't do this PowerPoint. It should say cash. I was like, why is that? Why does it say line of credit? So check number 628. It's coming out of our cash. So here's the transaction. Patent is an asset. And then like I said, patents only last a certain number of years. So they have something called a useful life and a legal life. So an amortization is the spreading of the cost of an intangible over its useful life. Okay. So that's what we're going to use. So the original cost of that patent that we just bought was 45,000. It's going to have zero because as soon as it's available to everybody, it no longer has any value. So we're going to have to amortize or depreciate the whole value. We take the 45,000, it's going to depreciate over 10 years, 4,500 a year. And so every year, notice the patent is our credit. Every year, the value of that patent is going to go down. So I'm going to use an account called amortization expense. So it's similar to depreciation, but it's got its own account. And I'm going to reduce the actual value of the patent by that amount every year. So that's it, guys. So make sure that you are watching this video and you're ready to get to work on your work togethers on Monday. Or no, I see you guys on Tuesday. I don't know. No, on Monday. Okay? All right. Thanks for watching.